Well, joining me now with more is Bill Adams. He's SVP and Chief Economist at Comerica. Bill, it's great to have you on the show this morning, and investors seem to be responding well to this inflation data. Why do you think that is?
Good morning, Kristen. I think this is a case of no news is good news. The CPI report was basically entirely as expected. If you look a little deeper into the details, the supercore CPI, that's service prices excluding energy services, excluding shelter costs, we're also up 0.3% month over month. So all of these different measures of the trend in the CPI index showing that inflation, while not quite back at the Fed's target, is behaving better than it was a couple of years ago. There's no sign of acceleration in pricing pressures, and that will be enough for the Fed likely to make a cut at the December decision.
I do want to talk about the inflation picture more broadly, Bill, because there does seem to be some concern in the wake of a red sweep in D.C. that inflation might tick back up. That would be on the back of mass deportations, which could lessen some of the less expensive labor that we see in this country, as well as tariffs raising the prices on goods if those are actually enacted, and tax cuts as well, simply putting more money in people's pockets. How do you factor that in when looking at the inflation picture ahead?
Those are going to be important drivers of how the economy performs in 2025. And the way we're factoring that into the forecast is we're assuming that the economy does continue to run hot next year and runs tight because of this policy mix that, in particular, the tariffs are going to provide more pricing power for domestic manufacturers, provide some upward pressure on goods prices likely in the mid to second half of next year. Other policies, hard to know when they're going to be enacted, hard to know the extent. Congress is going to have a say on some of this. So we're not factoring in really specific assumptions about them, but basically all added up means that the Fed will probably be reducing interest rates less in 2025 than they had been signaling prior to the election. So expecting further rate cuts next year, but at a slower pace than what we saw between September and December of this year.
Interesting. I want to talk about the categories. Of course, it's a goods and services economy, and many people have seen, certainly when it comes to services, whether that's their rent price, what they pay at the doctor office, whether it's for insurance, you name it, those have seemed to be sticky and hard to come down. Is there any relief in sight in that particular sector?
Well, for service prices, one of the big components of the cost of providing services is the cost of labor. And so one subset of those sticky service price inflation is the cost of daycare, the cost of elder care services, food services, so restaurant prices. With wages rising faster than they were pre-pandemic, that has put upward pressure on that category of service prices. But the labor market looks pretty well balanced right now. The unemployment rate at 4.2% has a normal degree of slack. And with that, I'm expecting wage increases to continue, but at a more moderate pace in 2025. And so I think that will take some of the edge off of labor-intensive service prices increases next year. The other part of that is homeowners insurance, auto insurance, where these insurers are passing on the cost of more expensive repairs and replacement of assets in higher insurance premiums. And that I think of as just kind of momentum from the high inflation that we've had in the last few years that will take a while to peter out.
I want to get your take, Bill, on the state of the labor market. Of course, we got the jobs report just on Friday. It did show that hiring rebounded after worker strikes and, of course, some extreme weather that we saw in the month of October. We know how people feel about their jobs and whether or not they're employed does impact the inflation picture because it determines how much they spend. What is your forecast for jobs going forward?
I think we're going to see more job openings in 2025 on the back of kind of an animal spirits effect following the election. Obviously, not everyone got the outcome they wanted in the election, but if you look at a number of business sentiment surveys, like the ISM Manufacturing PMI Index, like the National Federation of Independent Businesses Optimism Index, They're showing a rise in sentiment following the election. And I think a lot of hiring managers are going to be, at the margin making headcount decisions based on how they're feeling. And so I think that will mean a little more risk taking from business and a little more willingness to hire in 2025.
And what does that mean for overall growth? GDP growth?
I think Right. So GDP growth, I think, is above trend in 2024. We had really solid growth of 2.7% this year, in large part because of continued fiscal stimulus and strong growth on the supply side of the economy. In 2025, I think we're likely to see growth continuing at this strong pace with the boost from animal spirits, expectations of incremental fiscal stimulus. And I think that will mean a continued hot economy. So I'm optimistic for the outlook for next year. I think it's going to be another good year for the U.S. economy.
Certain sectors, Bill, that you anticipate to be big winners amid all of this?
Manufacturing is one part of the economy where, looking at those surveys, they are looking for better pricing power in 2025. And that should help hiring and help a rebound. We've also seen a big drag on manufacturing activity in the last 2 years because the construction sector was weak. And with the Fed gradually reducing interest rates, that should help construction, which should boost demand for construction materials and that part of manufacturing. And then I think we're likely to also see the tech industry continue to outperform. I think the adoption of AI technology, obviously there's a lot of hype there, but it seems like there's also a kernel of real value being created, and a lot of those technologies can be transformative in the IT in our economy, which is a growing sector and penetrates more and more. So I think that story has legs and has a way to run.
Bill, we covered a lot. Thank you so much for joining, of course, on the morning of a key inflation report. That's Bill Adams. He's SVP and Chief Economist at Comerica.
Thanks for having me.